Rob, someone say that this extreme concentration is indicative of a bubble. What do you say about that? And if it is a bubble, should investors be buying into it right now?
Well, firstly, yes, I think it is a bubble. Bubbles don't mean that companies like Nvidia are bad companies about to blow up. This AI revolution is very, very, very real. But you can get markets ahead of themselves. If you look at the tech bubble, the dot-com bubble in 2000, take the 10 largest market cap tech stocks in the year 2000 and ask the question, how many of them beat the S&P over the next 15 years? Zero, not one. One beat the S&P over the next 20 years, Microsoft, by about 1.5% a year. So it's not a matter that this isn't a real revolution. It's a matter that the market pricing gets ahead of the plausible reality. With Nvidia, you've got a company that on its latest quarterly run rate revenues is producing 100 billion annual revenue and producing 60 billion annual run rate profits. It's priced at over 3 trillion. So that means over 30 times revenues and over 50 times profits. Now, does that mean that the profits can't go up from here? Of course not. But they can also go down. Nvidia's most recent fiscal year, revenues and profits more than doubled. In the previous fiscal year, revenues were flat and profits fell over 50%. So do we really think that Taiwan Semi and Intel and AMD are going to sit on their hands and let this company dominate the super chip market forever? Or do we think competitors will play catch up, produce competing product, and squeeze those profit margins in the years ahead? Of course that's going to happen. It happens every time with every tech revolution.
So you wouldn't be using a pullback necessarily to get in here, especially for those who haven't been in and maybe trailing the market as a result. So what would you do as an investor if you were kind of looking at this scenario, looking at the market concentration, the potential of a bubble? I mean, is this the time to kind of just wait and see?
Oh, no. This is a time to begin averaging out. People talk about averaging into buying dips. You can also sell spikes. And over the last 10 years, the top 10 market cap stocks in the U.S. went from being 17% of the top 500 or the S&P 500 to being 37%, more than doubled. What about the concentration at the business level? The 10 largest businesses in the S&P measured on sales went from being 15% of the S&P 500 sales to being 19%. So the concentration levels are very, very different when it comes to big businesses getting a little bit more concentrated and market cap becoming massively more concentrated. That's dangerous. It's a wonderful time to begin averaging in to value. Value is cheap, measuring relative valuation, relative price earnings, relative price to sales. The spread between growth and value is 8-to-1. Historic norm is 4-to-1. Value would have to double in order for it to just get back to historic norms of relative valuation. So I look at this as a wonderful opportunity, third opportunity in the last 4 years, to top up value if you're underexposed to value.
Rob, I wonder if you say value looks very cheap on a relative basis, and of course that allows you to essentially get the benefit in that relative analysis of the extreme valuation perhaps in growth, and the fact that growth is so outperformed and mega cap has outperformed small and the U.S. has outperformed the rest of the world. So it seems like there are all of these kind of dynamics that look like they're very lopsided right now, and you can actually play some mean reversion. But do you think value, as you define it, is now priced for good absolute future returns?
In the U.S., I think it's priced for good absolute returns. Outside the U.S., I think it's priced for great future returns. So the U.S. is the most expensive major market in the world. It deserves to be. But by the margin that it is, U.S. versus European valuation multiples are 2-to-1. U.S. versus emerging markets are almost 2.5 to 1. Emerging markets were more expensive than U.S. markets back in 2008. No wonder they've underperformed so horribly. And when it comes to value, fundamental index, the idea we pioneered back in 2004, has, and there's ETFs available, has outperformed the value indexes in 15 out of the last 17 years by over 4,000 basis points, winning by an average of 2.5% a year with only 2% variability. So that's, if you want value, fundamental index is a phenomenal way to capture it. But the more important decision, I think, right now is if you're underexposed to value, this is a great time to enter in. If you're overexposed to tech, this is a great time to take some of those gains and basically let the house money run, but take your initial investments out.